Hello everyone. When European colonialism swept across the world, it left a deep scar on both Africa and Asia. These continents were exploited, their peoples subjugated, and their economies reconfigured to serve European economic interests. However, the economic trajectories of Asia and Africa, post-colonialism, present a sharp contrast. In 1960, both Asia and Africa were desperately poor, with high poverty rates and weak industrial bases. Asia began its transformative journey in the 1960s and 70s, with export-oriented industrialization policies. Since then, Asia's GDP has risen 160 times, from $250 billion in 1960 to $40 trillion today. Africa's GDP has also grown, but at a much slower pace, rising 50 times, from $60 billion in 1960 to $3 trillion presently. While many Asian nations have emerged as global economic powerhouses, most African countries continue to grapple with economic underdevelopment. Today, Asia is home to some of the world's most dynamic economies, from Singapore, South Korea, and China, to India, Indonesia, and Vietnam. In contrast, much of Africa still struggles with poverty and underdevelopment. More than 450 million Africans live below the poverty line. That's 1/3 of the population of 1.4 billion people. So, how did Asian nations manage to shake off the shackles of their colonial past to achieve economic transformation, while Africa has continued to fall behind? Well, the answer is not simple. The economic divergence between Asia and Africa stems from a complex interplay of historical, political, and structural factors. In this video by Africa Rebound, we explore the key factors: the legacy of slavery, colonialism, neocolonialism, leadership quality, economic development expertise, technology gaps, and lack of unity to explain the significant economic divergence between Asia and Africa. Now let's dive into it. 1. Africa's economic challenges began much earlier than the onset of colonialism. The transatlantic slave trade, spanning from the 15th to the 19th centuries, devastated African societies, extracting an estimated 12 million people, mostly young Africans. The transatlantic slave trade destabilized political systems and economic structures. The systemic depopulation and social fragmentation of Africa left enduring scars and hindered post-independence nation building. By the time Africa was partitioned by Europe at the Berlin Conference in 1885, the continent was already reeling from centuries of political, social, cultural, and economic destabilization. Unlike Africa, Asian countries, though colonized, did not suffer the same scale of depopulation or disruption through slavery. Asian populations remained largely intact, allowing for cultural, intellectual, and economic continuity post-independence. The residual trauma of slavery in Africa continued to worsen ethnic divisions and weaken people's trust in institutions, thus creating a fragile foundation for economic development. 2. The nature of colonialism was also different. In Africa, the colonial powers were primarily extractive and more interested in precious metals like copper, gold, diamonds, platinum, and agricultural cash crops like tea, coffee, cocoa, rubber, cotton, etc. African colonies were designed to export Africa's raw natural resources, not to develop human capital or infrastructure. In contrast, parts of Asia, such as South Korea, India, Malaysia, and Singapore, became administrative, trade, or military hubs. This meant more investment in infrastructure like roads, railways, ports, and education, even if it was to serve foreign interests. Furthermore, many Asian economies were strategically integrated into Cold War-era Western alliances and received substantial aid and market access, whereas Africa's geopolitical marginalization limited such opportunities. Therefore, at independence, Asian countries inherited a better foundation for industrial and economic growth than African countries. 3. Even after gaining political independence from Europe, Africa struggled to gain economic freedom. Neocolonialism has kept African economies in subordinate positions. Under neocolonial practices, foreign powers use trade, economic, political, or cultural influences to indirectly control or exploit developing countries, even after they have become officially independent. African nations remain largely tied to their former colonizers through exploitative trade terms, debt, and corporate control of resources. In Africa, we have continued to export raw materials and import finished goods, a structure that favors the global north and stifles local industrialization. On the other hand, Asian countries, especially the Asian tigers, South Korea, Taiwan, Hong Kong, and Singapore, were the first to break the mold. They deliberately shifted from exporting raw materials to manufacturing and high-tech industries. Governments provided subsidies for productive sectors, local industries, and partnered with global corporations, but on their own terms. Furthermore, many African nations implemented structural adjustment programs, or SAPs, imposed by the International Monetary Fund (IMF) and World Bank in the 1980s, which introduced privatization and free markets. Conversely, Asian nations like South Korea and Taiwan resisted such pressures and protected local industries. 4. The quality of leadership has also played a crucial role. After World War II, many Asian nations were led by visionary, selfless leaders who were deeply committed to national economic development. In Japan, South Korea, Singapore, and later China, leaders invested heavily in education, technological development, and industrialization. They promoted exports, built strong institutions, and were often quite ruthless against corruption. In Africa, while there were a few truly great post-independence leaders like Kwame Nkrumah of Ghana and Julius Nyerere of Tanzania, many others, unfortunately, were opportunists. They weakened institutions. Corruption and nepotism also flourished. Military coups and counter-coups, civil wars and dictatorships became common, setting back economic development by decades. In essence, Africa's political and economic elites, more often than not, merely replaced colonial masters without dismantling colonial economic structures, thereby continuing the same cycle of dependency. 5. Technological advancement has also been central to Asia's economic rise. From Japan's post-war economic miracle to China's current boom in artificial intelligence and electric vehicles, Asia invested heavily in research, innovation, and manufacturing. Education has always been a top priority in Asia. Countries like South Korea and Taiwan, notwithstanding their limited natural resources, transformed into tech giants through universal education, with emphasis on STEM education and vocational training. Furthermore, Asia's earlier integration into global supply chains provided technological spillovers, whereas Africa's reliance on raw material exports has stifled diversification. Africa has struggled to prioritize technology learning and acquisition. African countries spend more on the importation of foods and luxury goods than they do on research or tech infrastructure. Educational systems are often underfunded and misaligned with the needs of modern economies. Without technology and innovation, Africa has found it hard to climb the global value chains. 6. Another important factor is the approach to economic development and coordination. Many Asian countries understood the importance of long-term planning, industrial policies, and economic coordination. They studied how the West industrialized and then adapted those models to fit their own context. Countries like China and Vietnam adopted state-led capitalism, while South Korea embraced a mixed economy with strong state institutions. They built up domestic industries, promoted exports, and managed foreign investment strategically. In Africa, however, economic policies have often been influenced by international Western institutions, like the IMF and World Bank, leading to structural adjustment programs that devalued currencies and opened up markets too quickly, often with adverse effects on local manufacturers. Moreover, economic planning expertise is often imported wholesale without sufficient adaptation to local realities. This has led to many cases of economic policy failures and wasted opportunities across Africa. 7. Asia has also benefited from much stronger regional cooperation. The Association of Southeast Asian Nations (ASEAN), for example, has become a powerful bloc for trade and investment, and China, Japan, and South Korea have maintained important bilateral and regional development partnerships. In contrast, Africa's regional integration remains rather slow. For example, despite the launch of the African Continental Free Trade Area, border restrictions, colonial fault lines, and rivalry still hinder intra-African trade, which remains less than 15%, compared to over 60% in Asia and Europe. Without unity, African countries have limited bargaining power in global markets, operating as individual nations. In summary, Africa's economic challenges are not due to any one single cause, but a combination of deep-rooted historical injustices, post-colonial missteps, leadership failures, and poor economic development practices. But the story is not over. Africa's case is not hopeless. Africa has the youngest population in the world. Africa has abundant natural resources, growing digital connectivity, and immense entrepreneurial energy. With visionary leadership, regional cooperation, investment in education and technology, and a clear break from the neocolonial economic model, Africa can chart new pathways as a united and prosperous continent. It's time for Africa to write its own story of transformation. And this time, the world really should pay attention. May God bless Africa. Thanks for watching.